Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and then generate consistent returns year on year. So the first thing you want to do is just navigate to any equities underlying, and then you want to pull up a list of expiration dates for that underlying. And the purpose of this step here is to lock in on an expiration date. Before we even look at anything else, we need to know where we are in the options cycle and how far out do we want to go. So we want to be between 30 and 60 days out in time. And the expiration date also needs to be a monthly expiration, not a weekly or quarterly expiration. And so the only expiration date that actually fits that criteria right now is January 17th, which is 50 days away. So we can take that information, come over to our watch list, and we can simply filter out any underlying that has earnings over the next 50 days. This is simply just a standard watch list, a pre-made watch list even. You can make your own watch list, it really doesn't matter. And you also want to filter out anything that has a low liquidity rating level. Now we just go down the list. I've got it ordered from high to low IVR. You don't have to do that, but we just go down the list now at this point, and we just see what would fit well in our portfolio. The market is currently closed. This is pre-market. Market's not going to be open for about another hour and a half or so, but we can still go through and have a look at some stuff. So EWZ is looking quite nice. It is an ETF. It's a MSCI Brazil ETF. ETFs don't have company risk, so your P&L tends to be smoother. However, overall, it will be less than um, your P&L will be lower than if it was an individual company. In most cases, however, you will have a smoother P&L curve. So EWZ is trading at just under or just over $26. It's got an IV rank of 82, and its absolute IV level is 39.7%. So if we just pull up the January 17th expiration date, which we've already selected, at this point we want to just sell one call and one put, and we want to sell those contracts anywhere between a 15 and 20 delta. So we've got a 17 delta on the call side, and we've got a 16 delta on the put side. Now, this is not the best example because the market's currently closed. It's currently showing up as nothing there. Once the market is open, I'm sure this won't be zero. There will be an actual price on there. But just to give you an idea of how this works, right? So you'd collect premium upfront, and that's non-refundable, and your broker is going to require X amount of buying power to hold from you uh, during the course of this trade. You have your probabilities of profit here, and your probability of hitting 50% of max profit over the next 50 days here. So if we were just to get rid of this and just go to something else, let's say GLD, again, January 17th. If we just pick, say, the 19 or even the 20 delta on the call side, and then we go with a 19 delta on the put side, this should make a lot more sense. The numbers are filled in. Of course, the market's still closed, but it should help you pick up a sense of what we're trying to get at here. So in this case, we'd collect $313 up front. Our broker is going to require just under $5,000 in buying power. We've got a 70% pop and 83% of hitting 50% of max profit. We can buy another contract. So let's just say we bought a contract $3 away on either side. We've essentially created a $3 wide range. Our buying power significantly reduces. So this is how you can manipulate even larger underlyings to still fit inside your portfolio, no matter what size portfolio you have. Now, how do you know how much buying power you should be allocating? Well, we've got a position sizing template that's free for everyone to get a copy of. Link is in the description. Click on the free position sizing template. And the way it works is you enter in the size of your portfolio up here and then the VIX level below it. And then everything will then be automatically calculated for you. And as long as you follow this guideline, you'll be absolutely fine over the long term. If you want to learn in more detail about what we're doing, how we're doing, click on the link in the description, head on over to EDS Premium, get yourself signed up. Inside, you will have access to our portfolio so you can see the positions that we're placing, how we're managing risk, etc., etc. There's adjustments that we're making all in real time. There's also a full course, so no prior knowledge is required. We will teach you absolutely everything you need to know. It's a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee, so after 6 months, if you study the full course and followed our positions, if at that point you haven't seen results, then we will work with you for free until you do, or you can simply request a full refund. So it's completely risk-free on your part. Right now, the price is £1 a month to join. The price will be increasing once you're inside. Sorry, the price will be increasing. However, once you're inside, the price is locked in for you, so you don't need to worry. I had that the wrong way around then. So you are rewarded for getting in early. The price will never be cheaper than this, ever. And with that being said, I will see you guys on the inside.